Jacqueline for about 4 seconds and then start the program. Well, good evening, everybody, and welcome to the May 2025 Investing Roundtable, sponsored by the Mid-Michigan chapter of Better Investing and Manifest Investing. And tonight, besides myself and Mark Robertson, we have our friends Cy Lynch, Kevin Galagli with us to make stock presentations. You've met both of these gentlemen before, and Cy's a regular full night of the roundtable, and Kevin is a good guest night from the Maryland chapter of Better Investing. So we're not going to take a lot of time getting into this, so let's move quickly through the slides here. Mark, we'll do the wrap up. Why don't you talk about your artwork on the opening screen, Mark, okay?
How long do I have? The artwork was actually inspired by Kevin. Kevin is he's trying to make all of us a little more fashion aware and fashionable. Hence that's the Sly and the Family Stone and that medieval artwork on the left, along with their hit Dance to the Music. We're going to talk more about that in a few minutes. But then, just to demonstrate that Kevin, we're not starting from zero here, not starting from scratch. Cy Lynch has on his Atlanta Braves Chief Nakahoma headdress, and Kit Ken and I have our toques and our those are actually cherry fritters. And Kevin, that image of yourself, chiseled by the way, is from the session 2 years ago when you first joined us at the roundtable. So we thought we would celebrate that a little bit too, and that's pretty high level of fashion also.
If you say. Yes, keep moving.
Let's go to our disclaimer, Mark. I think you've given us enough information about that. This is not a place where you come for stock recommendations, folks.
Or fashion advice.
This is a place where you come, or fashion advice. This is a place you come for education. Everything we do tonight is for educational purposes only. We're making no recommendations to buy, sell, and hold. We will be showing you some stocks that we think should be added to our portfolio, the roundtable portfolio, but we ask you to do your own research, do your own homework, and make your own decisions. We're not the boss of you. We think you're plenty smart enough to do all this work yourself and draw your own conclusions. If you're not already on the Mid-Michigan guest list, then you can go to betterinvesting.org/chapters/Mid-Michigan, and you'll see a form there if you scroll down to the bottom where you can put yourself on our guest list, and then we will contact you once a month telling you when the roundtable is and offering you a link for registration. If you like copies of these slides, they're going to be posted on our YouTube channel, but you can also write directly to Mark R. at manifestinvesting.com, or send me a note, kcavula1@comcast.net. We'll see that you get the slides. You can get the whole shebang, however, with the commentary and everything at our YouTube channel. Search for Roundtable or Manifest Invest at the YouTube site, and you'll find all of our programs for the last 13 or 14 years. They're posted there, and we're glad to share them with you for just coming and clicking on them. I think I've covered this pretty well, Mark, so let's look at the next slide if you would. Here's our roundtable slide. Folks, we're having a hard time keeping up in this very volatile market. Our relative return is down at 2.7, which is still a superb relative return. Our total return is just under 16%, and that's for over 15 years of selections in the roundtable tracking portfolio. So anytime that you can show me a 16% return over a period of 15 or more years, I think you should take it. I would certainly take it, but I would love to see that line begin to move back to that dotted orange line, which would indicate we're trying to stay ahead of the market by 5 points. When the market does 2% gains like it did again today, it's very difficult for the stocks in a small portfolio to keep track of what's happening right there. Our outperformance accuracy, which we'd like to see at 55%, that means the number of stocks that we've picked that actually beat the market is down at 44.2%. That's moving up ever so slightly and ever so slowly, but it is moving in the proper direction. So I don't think I have anything else to say about this slide. Mark, do you have anything to add?
No, just to reinforce the context of this would place us at like number 30 amongst 600 or 700 equity mutual funds. So we're still in the top tier of performance. We've just dropped out of the top 10 or 20. We prefer to be in that top 10. So hopefully we'll make it back there. And I would also note that I can't explain it. A lot of those off the radar stocks are just behaving really weird lately. And in fact, we lost ground in the outperformance accuracy. And it's a bit mystifying and frustrating. All right. Here's a new slide for you, Ken. I think you'll like this one.
Well, Mark just kind of showed this one to me. This shows our recent best choices in the roundtable here since last October or so, last September, last August.
Last year.
I guess it goes back to last year, yeah. And we have made some extremely good picks. If you were with us in September and bought some of Kevin's choice and my choice, you really are feeling real good about the roundtable, because Oddity Tech has more than doubled in that period of time, and LPL Financial has moved up over 70% in that time. Matt Spielman's Interactive Brokers is also in that rarefied territory, up almost 70%. The rest of them are doing quite nicely as opposed to the market. Remember, that's relative return, how much the stock has beaten a benchmark, and we're using the Wilshire 5000 as the benchmark that we're comparing everything to. So the audience is faring fairly well, having picked 3 of the top stocks. You didn't pick Oddity or LPL in September, however, so shame on you for that. But you picked Ann Manning's Lululemon and My Monster Beverage and my Fortinet choices that have been made all within the last year. So we'll give you a chance to make another choice tonight, and we hope that you'll give us the kiss of opportunity with picking a stock that will make us the same kind of relative return that these stocks have made. It's just a very interesting collection of stocks, and it shows that the folks making the choices, for the most part, are still they still have it some months, at least, not every month, but some months we're doing fairly well.
All right. Here's the top 20.
I did the whole slide, Mark, without mentioning that your name wasn't on it anywhere. Okay?
Yeah, but you just blew it.
Oh, all right.
Ken, wait a minute. Go back to that previous slide. Where's Ken's name? Where's Mark's name on it? I'm having trouble seeing it.
It's not anywhere on that slide.
We're moving on. We're moving on.
So, Mark, why don't you describe this slide? Tell us about this one, okay?
All right. This is the top 20 by percent of total assets. Anytime that we make a selection by a knight, a damsel, or the audience, we basically add $1,000 to it in the portfolio. The legend on the upper right gives you a key as to how many times certain stocks have been added. Microsoft, for example, has been added 5 times. So you find that out here. So $5,000 invested in Microsoft is now this. More on that in a second. But those are the top 20. You can see the entire collection by going to this public dashboard and taking a look at it. But we continue to try to drive up the overall portfolio par and the overall portfolio growth rate, and we'll keep pressing on. There's just a couple companies underneath money market rates. When it comes, I could stand to see a few of those goes. I think I had already suggested that CBOE could be jettisoned, and we probably should give some thought to dropping a couple of those along the way. I'm not sure what the outlook for Air Lease is with all the stuff going on. in that industry, but we should probably give that a look also. And Interactive Brokers is here just because of the very strong price performance since selection. So that's all I got.
I think, Mark, we also might want to take a look at some of the stocks that have slowed the growth. We don't normally pick stocks that grow at 4, 5, 6% for consideration for the portfolio. And yet, when you look down the growth list, even on the top 20 here, you see some stocks that have moved down into that 4, 5, 6 range with sales. And we might be looking at some of those to freeze those positions out as well, you know?
Absolutely. All right, now I'm not going to do this slide every month. I keep saying that, but last month it was a bit dreary because we had actually fallen behind on those bottom two numbers. Again, this is a slide that we suggest people use for anybody who might be reluctant or fear investing in the stock market, because as we point out here, we've made nearly 900 selections since 2010. And as Ken just mentioned, the rate of return on those selections is 15.9. And the interesting point is basically a fourth of them have values less than $1,000. In other words, they've backed up in price a little bit. You add up all 232, you get a loss of approximately $97,000. But what is fascinating and continues to give us great joy is Microsoft alone more than offsets that loss, because we have $106,000 in Microsoft right now, as you saw in that preceding slide. And that basically offsets all 232 losses, whether they're realized losses or unrealized losses. So again, our favorite expression, what are we afraid of? We don't think that there's cause for fear or justification. So we're not going to show this every month, but we do like to keep those statistics up to date, and it's kind of fun and reinforcing. Anything else? Good to go?
We're good to go. I'm reading the question boxes here, Mark. Our audience, as usual, George Mackey and Len Douglas have come through and told us that plane was most likely an Airbus plane that Ann took with the Gentech windows. Thank you for the information. We can always just put a question out, and our audience is almost always able to answer it for us.
Mm-hmm.
And Matt Spielman, who's in our audience tonight, is concurring with you about Air Lease. He thinks it's probably the best company in its industry, but he does think that it might have peaked out for quite a while at the moment as far as par is concerned.
Okay. All right, ready to press on?
I think so.
You know, you give a guy a little bit of advance notice, and you know, you never know where he'll quite take it. So, Kevin, take us away.
Yes, for those that don't know, Mark and Ken seem to think that they can give me, 24 hours to be able to come up with a stock presentation, and they're generally right. This one is a full week. I actually just did this for my model club, the Montgomery County, Maryland Model Investment Club. But yes, I was ecstatic that I had a full week to be able to have this stuff ready. So tonight we're going to talk about Inditex. I'm not going to say the Spanish name of it, but go ahead and give it a shot. But the ticker, what is generally called, is Inditex, and you'll see it there. So let's go to the next slide. And what we were doing in our club is we were looking for stocks in areas that we weren't really covered well in: cyclicals, consumer defensive, industrials, materials, and we were looking for stuff. And we were like, okay, let's look at stuff that had like maybe minimum growth, because sometimes some of those companies don't have great growth, but they have generally straight lines, but give us good management and good Morningstar grades. And we went through 4 different sectors, and it was actually the one here in consumer cyclical, which we probably didn't need as much. But again, Ken talks about this, that when you look at a screen and you see several of the names that are in there and they're well known to you, then I'm sort of intrigued to look at the other ones. And quite frankly, on this list here, I've heard presentations on everything except for Inditex, which I'll talk about tonight, and the one at the bottom, trip.com. So it tells me that the screen that we sort of set up was actually pretty good. So let's go to the next slide. And so here's Inditex. It's on the trades on the pink sheet. So I know for a lot of you that means I've lost your vote already. Sorry. It's an ADR. So it's a foreign company, and it's a large size company. And it's in apparel retail, which is always sort of real fickle. But it's a leader in what's called fast fashion and ultra fast fashion. And I'll talk about that in just a moment. Its headquarters is in Galicia, Spain, which is nowhere near Madrid. In fact, if you were to look at the Iberian Peninsula and you look just due north of Portugal, that part of Spain that's north of Portugal, that's Galicia. And so but again, look at the stuff here over on the right-hand side, financial health grade of an A and a manifest quality of 98 and a core score of 259. All excellent scores, and I'll talk about those a little bit more. The downside is no coverage from Value Line, CFRA, or Morningstar. So I've lost now another group of you. So I'm probably down to 15%, and hopefully by the time we're done, maybe I can keep it above 5. So let's keep going.
It's like Survivor.
Well, and not only that, just to let you folks know that when I did IDEXY back in September, I got like 2%. So there, suck it. And, I thought I could do fashion because, Ken talked about fashion at Bink last year. He was talking about Louis Vuitton. So I know all of you went out and bought it because Ken said, look at it. So you all went out and bought it. I don't feel the same way. But Inditex is actually, like I said, they're one of the 4 largest in fast fashion, and the other ones that are in there is a Swedish company, H&M, and then the other 2 that are another one of Ken's favorite Chinese companies, Shein and Timo. So if I haven't gotten you already, just to be able to say, look, these are probably more stable than Timo is Shein. Maybe I went up to about 18% on a vote here. Let's go to the next slide. So, when you get something like this, it's always good to look at the visual analysis. And if you look at it, it looks pretty good. You see the big dip. Surprise, surprise, that's in COVID. And it also looks really good if you look at the trend lines, both on pre-tax profit and on earnings. When you see those solid numbers above it, it's telling you that it's really improved. So that means that historic numbers of 5, 6 for both sales and earnings are going to be significantly higher. Let's go to the next slide. And this is what it looks like post-COVID. So there's 4 years, and now all of a sudden it's 9% for sales and almost 20% for earnings. And look at that, evaluate management. They're all excellent. They're all in green. Again, that was one of the screening criteria, so of course we'd expect to see it. But to me, there's some stuff they'd like, all right, I can take a look at this. And again, I knew nothing about this company before I did this presentation. Next slide. And so let's look at, like I mentioned a little bit at the beginning, you see a core score of 259. And here again, it has a quality of 98. And you look at some of the others that are in apparel, they're ones that we all tend to know. Lululemon, AMF is Abercrombie and Fitch, TJ Maxx, a favorite of Ken Kavula, and BKE, it's what, Buckle? Is that what
Buckle.
It is?
That's correct.
I think it's Buckle. So you can see it's got there's some interesting ones in there. Now its par is a little bit below what we want to do, but if you look, there's a decent but not great projected return on value or prove at 8.8, and a sales growth of 13.1. So there's a lot of things here to take a look at and go, all right, let's continue. Let's go to the next slide. So, and again, here it is, a financial health grade. That means it's in the top 10%, and this talks about some key balance sheet issues. Now, if you were Bakul or Kim Butcher, that isn't good enough for you because you're going to dig into those financial statements to make sure you get them right. But for those of us that like a little bit of a shortcut, here's Morningstar. They're looking at the key balance sheet issues, and they say this is in the top 10% of all the companies that they look at, and there's about 3,000 of them. So between what I see on Manifest and what I see here, plus the visual analysis and the screen I did, I think there's enough to go forward with it. Next slide. So let's talk a little bit about fashion. And throughout my presentation, I have hyperlinks, usually YouTube videos of about 6 or 7 minutes that are pretty good. The fashion industry is very fickle. They have the production of raw materials. They need a lead time to be able to figure out what the latest design is. And, you know, they need to be able to then send stuff usually to remote manufacturing facilities in Asia, China, Vietnam, and the like. The contractors, and then they have to do their promotions and, you know, set up the buzz that gets behind it with retail sales and stuff. And that's sort of the general fashion operation. Let's go to the next slide. And if we look at the largest fashion retailers, the one thing that's really kind of striking about this is that most of them are non-US companies. You know, you got Louis Vuitton, Dior, Inditex, which I'm going to talk about, Adidas, which is more, you know, obviously footwear, Nike just above it, footwear, H&M, which is another one of the fast fashion, and then you see fast retailing out in Japan, and on and on. You can see a lot of them that are really outside the US. So it's like, okay, maybe they know something that we don't. And one of the things we were looking at in my club was that we were concerned about tariffs. Well, if you're with a foreign company, you're not going to have the tariff problems that you would if you happen to be a US company in fashion. So keep that in mind. Next slide. So when we're talking about fashion, you know, there are some people that are proud of the fact that they just have 3 shoes. And these are actually some clean ones, Mark. I'm kind of surprised you don't have your dog-eared ones up there.
Oh, you should see them now.
Oh, yeah. Well, truth in advertising. This is what you put up on one of your bull sessions, so I had to go with it, you know.
Okay.
But, you know, the trends change and products switch and stuff like that. We go to the next, hit advance. You know, other people, they really like their platform shoes like this, and they have like fish in the bottom heels like that. Do one more, and you know, this is the latest from the Louis Vuitton setup that came on out, and you know, this is what Ken sort of wears when he's sort of relaxing around his house. You know, spending all the money that he doesn't want to send to his kids and grandkids. So he's a slave to fashion. Anyone who's seen him in person knows he's always wearing the latest fashion and the like. Let's go on. Let's go further. And one more. So let's talk a little bit. So there is fashion apparel. There's traditional and timeless, like Ken Kavula there. And then there's fast fashion, which is, you know, the traditional fashion takes about 18 months to 2 years to get stuff to market. Fast fashion gets it in just about 3 to 6 months. That's from design or conception all the way to being in the market. And then there's ultra fast fashion, which can be anywhere from 2 weeks to like a month. And what's happening with this fast fashion and ultra fast fashion is that they're using what's omni-channel. That's where, you know, when they have their apps, they know when you're in the store, they know what you're doing, they're sending you notices on what's going on, and they can tell by what you're looking at what's interest, and then they can sort of have people come and design it. And that's sort of the difference with fast fashion and ultra fast fashion. Next slide. So it's a lot different than the way most of us, when we think of fashion, we think of Ken and his fine outfit there. Let's do a little bit more. Let's do one more on this slide.
Nothing says raconteur like that. I mean,
well, you know. So just like Ken talked about during bull session, is that, you know, you can just use AI to help you out. So I was asking about fast fashion. Here's what I found. It's a speed and trends. One of the things that happens with fast fashion and ultra fast fashion is that they use a lot more synthetics. So there's not all cottons and stuff like that, like Ken's stuff there. But the longevity is not designed to be very, very long. It's cost and affordable. It's really designed for younger people that want to be able to have latest stylish stuff and not necessarily have to, you know, fork out a lot of money for it. Next slide. So here's some more on this. And what I really like about this is that all the hyperlinks over on the left-hand side. I have stuff on Zara. Zara is the main store for Inditex. So if you take a look at that, there are Zara stores here in the US, but you can sort of see one of the things Zara does, and this happens with all the fast fashion, is rather than having these long supply chains that go all the way out to Vietnam or China, they're nearby. So like Zara being Spanish, they have a lot of stuff where their manufacturing plants are, where they make stuff is in Spain, in Portugal, and Morocco. What they do is they bring it all to a central hub in Madrid, much like, say, FedEx does, bringing everything to Memphis and then shipping it out. So about 98% of all their stuff goes in Inditex, goes to Madrid, and then it's shipped out. So this is a logistics company on top of being a fashion company, to keep that in mind. And Shein does the same, and so does Temu. But if you want to read a little bit more about they're either from Bloomberg or Wall Street Journal. So keep that in mind. Next slide. So as big as Inditex is, which is about 42 billion, in the industry that's 1.7 trillion, it shows you that even these behemoths are not dominating the market. So there's a lot of opportunity for growth if you're nimble enough to be able to figure out where stuff is. And so again, this stuff breaks down. So it's a fragmented market, but again, whether you're in shoes like Mark, or you're in clothes like Ken, the geography, the type of fashion that you're in, all of those things sort of help subdivide this thing. And again, it shows that there's a lot of room for growth still, as big as this company is, for more growth. Next slide. And so this comes from Wikipedia, because nothing's ever wrong on Wikipedia, of course. But if you look at this, this is a nice breakdown for me of all the different brands of Inditex. And you can see overwhelmingly their stuff is in Zara. It's actually the 72.5 is for Zara and Zara Home down there. But some of the ultra fast fashion is stuff that's with Berkshire in the middle at 7.3. But you can see what their markets are and what they're going for. They don't make many acquisitions, but here's one of the things Inditex did do, is they bought a sustainable agriculture company, because what they're trying to do, because what happens with this stuff, since it's really quite disposable, most clothes end up in landfills. So trying to figure out a way to keep that sustainable on the other end is something that Inditex and a lot of other companies are looking at it. And that's the acquisition that they have over there that happened just about a year ago. Next slide. Target market, again, millennials and Gen Z. So I think, again, with this audience here, I'm now down under 10% of you voting for me. That's okay. But if you want to be, one of the things that Inditex does is they don't spend a lot of money on advertising. Most of the people in this industry, like Temu and Shein, they spend 3 to 5% of sales on advertising. Inditex is under a single percent. And what they do is they build brands around it. They're really kind of do provocative or interesting stuff that's enticing enough. And again, their target market is millennials and Gen Zs, mostly women, not exclusively, but mostly women. And so those types of things and how they can build stuff with it without having to have these big runway shows in Paris, like Ken and Louis Vuitton. Next slide. So here's some of the competitors. And if you look over on the far right, you have Forever 21. They're fast fashion. They're in bankruptcy for the second time in like 11 years or so. And Shein owns like about 30% of them. American Eagle Outfitters is there. There's H&M, another one of the fast fashion out of Sweden. You see Gap. And there's, I like sort of looking at this, that sometimes they don't always show up as in our SSG. So I sort of like to see some of the other ones that are in there. So it's in a really pretty good place where it is. Next slide. And so here's my front side judgments. Again, I showed you this at the beginning. Let's hit one more. I think will show up. Here's my judgments. I went with 6.8 and 8.7. So I'm below where the last 4 years are. But, some of you may go, oh, much higher than the 10-year average or the the analyst consensus estimate. Let's go to the next slide, and I'll show you some of the judgments that went with this. This is just on earnings per share. You can see the 10, the 7, the 4, and the 1. The analyst consensus estimate is only 2 analysts, so it's not exactly like it's something I really want to hang my hat on. And the member sentiment is only 2 studies, one of which is clearly mine, and the other one probably is mine as well. So none of you are looking at this company, all right? So that gets me down now to probably about 6 or 7% voting for it. My preferred procedure did 7, Prove is at 8.8. I looked at implied growth, something that we used to use a lot when I came in a quarter century ago, and then my own judgment came out at 8.7. Next slide. So here's the implied judgment. You can find it on Bivio. Ralph Seeger liked to use it, but really what it is, it's an attempt to see how much a company can grow internally without adding more debt. and it's the return on equity minus times 1 minus a payout ratio. So this pays out a pretty hefty percentage. 60% goes out in dividends. And so that's 11.2. And like I said, I'm doing 8.7. As you can see, I'm being really kind of cautious with some of my numbers. Next slide. So here's my section 3 judgments, and if you look at it, they're consistent, but here's something that stands out right away. My current PE is higher than the 5-year average PE, so it looks like it's overvalued. So now I'm down to about 5% of you voting for me. But if we go to the next slide, you can see what my section 4 judgments, I went with 33 for a high, which is much higher than the 10-year average. But the reason is that 4 of the last 10 years had at least 33 or higher for their high PE. And that in one of those 10 years is COVID. So that's not an unreasonable number for it to hit. And with that, I get it to, maybe selling at about $50, and it's selling at 27 right now. Next slide. So I get it as a buy. And, one of the early directors, when I took my first judgment class here in the DC chapter, E.C. Eklund, he says when you get something like this, it's at 15% and it's not in the green, or if you're like at 14.8, if you really like it, just sort of tweak it to go with it. This is one I think it's a buy, but it's not an obvious table pounder. I could have tweaked things and made it a big buy, but I think it's a buy. If you want to be a little bit more cautious and wait a little bit, you can sort of drop some of the numbers and take a look at it. But again, with a high quality company like Inditex, with a high financial health grade and a really good core score, it may not always drop for you in price. So it may run away from you, but keep that in mind. Next slide. So it's a large size, steady growth. It's got above average management metrics. It's better than, it's either 1 or 2 on most of the management metrics. It's overvalued on historic data. It's slightly undervalued using projected data. I get it a buy at 27.30. When I did this a week ago, it was 27.37. It's in a cyclical industry. It's interest rate sensitive, fashion taste sensitive. But if you think the prospects for fast fashion are going to continue to hold, then I'd consider it a purchase. And that's what I am doing. So with that, and with some of that lukewarm stuff, I know I'm going to be down under 2%. So I'm done with, I'm happy.
Thank you, Kevin. Moving on.
Well, mine's not nearly as dramatic, Mark. This is IES Holdings.
I'm not.
And let's go to the first slide real quickly, okay? I was looking for a national company that I could deal with and that was taking advantage of the increase in business from data centers and from the power system in general, from the increasing needs for power. And IES fit both of those particular guidelines that I was looking for. You can see the coverage all over the country, and they operate in 4 basic divisions: communications, residential, infrastructure, and commercial and industry. And you can see underneath them on this slide some of the things that are included in those sections. The residential is their core business, the original business. This used to be Electrical Systems, the name of the company, and their residential business was most of their business. It still is about half of their business, but the growth is coming from some of the other divisions right now. They're getting good growth from residential, but they're getting exceptional growth in the other parts of their business at the moment. You can see the 5-year revenue growth is at 22%. That's certainly the kind of growth that we're looking for in a stock that we might want to consider. And if it has PE values that we consider reasonable, then we might be looking to actually purchase that stock. Let's look at the next slide. Many markets, many capabilities. When we talk electrical, we're talking about all facets of electrical. So we're not only talking about the wiring and the lights and things like that, but we're talking about all the systems that keep that wiring going. We're talking about service contracts that go into these very large structures and provide service contracts for entire factories or for entire data centers. We're talking about a lot of different things, and You can see that 50% that I talked about in residential construction on the circle graph there, but you can also see that about a quarter of their business is now in communications, and that light blue section, if you look at the bars from fiscal year 18 going forward, you'll notice that that's becoming a larger and larger part of their business. That's the part of their business that deals with these data centers that are cropping up all over the country, and deals with the technology in the power grid that has to accompany these data systems. They use inordinate amounts of power, and we have to find ways to provide that power to them if they're going to be of any use to the companies that are building them. Next slide, please. There's demonstrated growth in the company. They're very accretive. Becoming a national infrastructure company is not an easy task. If you looked back 25 years, you would find most of these companies were at best regional companies, and they've grown by not only organic means, but they've grown by acquisition as well. And there's some of the acquisitions that they've made in the last 8 or 10 years. A very, very strong financial position, great cash flow, a lot of money in the bank, and a demonstrated history of being able to take big companies, acquire them, and work them into their structure without very many problems at all. Next slide. They define 3 major goals: residential housing, and that's the traditional business where they do the kind of things you would expect, but this is not only single family homes, they do a lot of work in multi-family homes also. So this residential not only includes a really nice single family house, but it might include an 8-story hotel or an 8-story apartment building, and it might deal with 2-story condominium communities, things like that. A lot in technology, that's where the data center growth is coming from. But there's a lot of other things that they do in technology besides data centers. You can read on the slide some of the major things that they do. And then the evolving electrical landscape is the flowery language they like to use to describe it. But it's basically the fact that we have to rethink our grid. We have to revive it. We have to revitalize it. We have to make it more robust. It has to be able to transmit in a way that we're not going to lose power on a regular basis to our customers. And they're quite involved in dealing with all of these issues that circle around the grid. And you can see how all 3 of these goals tie together very closely for IES systems. Next slide. Their compounded annual growth for the data center construction is impressive. It's a 23% growth for data center construction. That's about a quarter of their business right now, and it's growing quite handily. You can see some of the sub-points that they've listed. These slides, and I chose just a very few of them from a very, very well thought out investor presentation that explains the business in detail. And then it takes a lot of effort to explain where the growth in their business is going to come from. And that's something that's very important to me. I don't want to know so much about what they did do as what they're going to do to continue to make money. And this company does a beautiful job in their investor presentation. If you're interested in IES, please start by looking at that presentation. Next slide, please. They do a lot of work with e-commerce, and what that means is that they're building some of the kinds of centers that e-commerce needs to operate successfully. Amazon needs their distribution centers located all over the country, and they have large electrical needs and large mechanical needs that you have to connect those electrical systems to. The same is true of almost any other company that's making a bid to be a big player in e-commerce, and that would include Walmart, for example. They are building distribution centers centers without as much fanfare as Amazon perhaps, but Walmart is putting these big distribution centers all over the country as well, and they need these kind of systems in order to operate the machinery that goes into these warehouse slash sorting slash distribution slash everything else that gets the packages out and delivered to your home in a day or two. Next slide. The demographics for the housing business, and remember that's half of their business, are with them. Their key residential markets seem to be growing by leaps and bounds, and they're basically centered in places where the population growth is very robust. We're talking Georgia, Florida, Texas, California, Washington State, and we're looking at growth in those particular geographies that's really more robust than you would find anywhere in the Midwest or in New England or even in the mountain or desert West. So they happen to be geographically located in places where their business is really growing because of the demand, and the demographics behind that demand are just they're frightening. We have a severe housing shortage. We don't have the number of houses we need to house the coming necessity of housing for the generation of folks that are in their late 20s, early 30s right now, and that those places are going to be built, and they're going to need electrical systems. Next slide, please. Here's just a simple graph of the housing expansion, the residential market. You can see that these bars are bicolored, and the dark part is single family homes, and then the lighter part is multi-family dwellings, all the way from duplexes that might house two families up to multi-story buildings that would house a large number of different families. And you can see that we're kind of back to an average number in the single family plus the multifamily, but the demographics indicate that we're going to need much more than average going forward for the next 8 or 10 years. So IES plans to take quite a bit of that business if they can. Next slide, please. Here's just so you get an idea of the different places that IES touches a data center. They don't just wire the building and then leave. There's all kinds of places where they have to touch, and then there's all kinds of places that have to be maintained, and they do all of that. They provide the building, they provide the installation, and then they provide the contracts to maintain the equipment once it is installed. The same kind of picture is on the next slide, if you would, Mark. And it shows the places that they would touch in an e-commerce distribution center or in a high-tech manufacturing center. And on these pictures, they've colored the places where they would touch in kind of that gold wash. So you see that there's all kinds of things that an electrical contractor would do, much more than you might imagine them doing as they build these huge factories or these huge e-commerce distribution centers. Next slide. Here's the visual analysis, and this is where I begin my study after I read the investor presentation from the company. And you can see that since the pandemic, the company has really reinvented its earnings trajectory. It's a whole different number than the historical number that you might look at. That trend line is not nearly as steep as the earnings line going from 22 up to 24. So when it says 37% on the historical earnings per share, you can bet your bottom dollar that trend in the last 3.5 years is much, much stronger than that. That growth trend of 23% going back to 2019 has been fairly consistent, a little bit of slacking off immediately after the pandemic because IES was able to draw business forward because they were able to do work with sufficient social distancing, that people were able to continue working during the pandemic. And then because they drew some of their business forward, their business slowed down a little bit immediately after the pandemic, but you can see that it has moved back to trend again, and that 23% growth rate is fairly accurate. I'm going forward with what I think are extremely conservative numbers of 15% growth and 16% earnings growth. And these, there is a value line sheet for IES, there is a manifest sheet for IES, there is analyst coverage for the company, and these numbers put me right smack into the middle of the pack as far as all of the projections going forward. I'm very comfortable with them. Next slide. 3 greens on the evaluate management section. Really manageable debt, especially for a company that does a lot of acquiring. Most recent year under 10% debt to capital, a robust return on equity to go along with that of 35%, and pre-tax profits moving in the right direction. And as they move to the larger buildings, the non-residential construction, the margins for what they're doing increase because they can add all these contracts for service that you would not typically provide to a residential customer. I'm looking at the section 3 with the 5-year PE averages. I did strike out the 2022 high and low numbers just to find out what the averages were, but you can see that the company, even though their earnings dropped from 21 to 22 because of the business pull forward, evidently the market did not lose too much faith in the company. It maintained a fairly decent high and low price for that company during that time period, and it's come roaring back now. It's been especially attractive in the last 4 or 5 months with extremely a robust growth, if you will. Notice that the current PE is around 20. Notice the averages at about 19 and about 7, because I'm going to make a startling revelation on the next slide, if you'll go there, Mark. I think this small, quickly growing company is going to experience PE expansion. And I'm using that current PE of around 20, maybe 19, to decide to set the average PE going forward. And if I'm going to use 19 as an average, I went up 3 or 4 points to 23 and went down 3 or 4 points to 15 and came up with what I consider very reasonable PEs for this very fast growing, relatively unknown company in the industrial sector. My PE of 19 sits right in line with where Value Line thinks the PE is going to be, where Manifest thinks the PE is going to be, and where a number of other sources think the PE is going to be. So I don't think I'm out of line at all. And that $179 low price is close enough to the current price that I'm not too worried about it, but far enough away to allow a little bit of volatility in the price. Next slide, Mark. These judgments, which I've indicated to you, gives me a par of 14.3. Manifest suggests the par is 14.9. Remember that Manifest par is using the same calculation as Better Investing's par is. So when I get 2 numbers that are close like that, I'm getting validation. I'm feeling really good about the thing. If the high PE turns out to be correct at around 22, 23, it could return as much as 19%. I like to think of it as maybe somewhere between 14 and 19% in the next 5 years. I think that's a pretty decent return for a company growing at a fast enough growth rate to keep the par for our entire portfolio up where it needs to be. And I'm suggesting that we put, next slide if you would, Mark. I'm suggesting that we add $1,000 of IESC to the roundtable portfolio. And this is just a slide reminding you of some of the kinds of things that they build and the kinds of things that they do. Thanks a lot.
Thank you, Ken. Good stuff. definitely in some areas of opportunity. Well, in keeping with Kevin's theme, I want to take us higher. And I haven't had a stock on the leaderboard for a while, so I think I'm due. So if you find yourself, out there in limbo, not wanting to vote for Kevin's, and you've got that, you know, extra vote out there, you're trying to figure out where to go, I'm going to make a pitch for it. All right. The other thing I wanted to point out is we actually inserted the chairman from this movie into that cover slide, and there's there's a backstory here. I'm not going to go deep into it, but Margin Call is a good movie. It basically chronicles the 2008 experience with Lehman Brothers, and quite a mess. But in this case, Jeremy Irons in the role of John Tull uh, is the chairman, and this is an exchange that he has with one of the junior associates who figures out that the company is basically uh, headed straight for hospice, basically what it comes down to. And he talks about the music stopping, and he has to figure that out before everybody else does. Anyhow, decent movie, and just encourage you to have a closer look. All right, so I'm going to do something a little bit different. I wanted to just kind of stroll through some quick screening results, and in my quest for a company for tonight's presentation. What you see here is basically taking the manifest investing screener and screening for a superior manifest rank. So we call this the ivory soap screen, and we're looking for companies with exceptional quality and a relatively strong projected annual return for the return forecast. And then I also limited it to a growth rate greater than 10%. So I'm looking for double-digit growth. Ken already said that this afternoon in the bull session that he doesn't like most of these companies. I agree. You start looking at companies with low financial strength, low earnings per share stability. You start kicking them out. Yeah, they go away pretty quickly. I do like these top two. I could probably warm up to a couple of them at the bottom, but others are a little bit less attractive. In keeping with tonight's theme, I just wanted to basically ask this question. What would be the best stock to add to this portfolio? According to Grok, which is the Twitter or X.com chatbot. So I asked that question. You can see it explains a little bit that it shows that it has some understanding that we're looking for high quality growth type companies, and scanned the portfolio using the link that I provided it. And then it said, well, for this portfolio, this is probably a decent consideration. I would agree. I mean, ASML, it's my understanding that they provide products to virtually all of the semiconductor manufacturers and part of the process. And they do some good work, very respected company. In our forum, Matt actually provided a CNBC report, which tours one of their facilities and talks about their latest run of product. And pretty good company. So that one goes on the list. Also turned to our friends at the Motley Fool and basically said, well, what are your 10 favorite stocks at this time? And you can see a number of community favorites on there. And Ken also objected to this list. There's a bunch of early stage companies, and there might even be a company in there that has no earnings or just a couple quarters worth of earnings. So that gives him the heebie-jeebies. And if I were to pick one of these, I would be in Kevin Gologly's neighborhood as far as the votes. But there are some very well established companies. This one here probably qualifies as a turnaround situation, new leadership, and pretty mature company, but some good stuff along the way there. Also checked in with Perplexity, another one of the AI engines that you can go to and basically just asked that question. I'm not sure I care too much for the results. We covered this in great detail during bull sessions today. It's almost like they forced companies from sectors, some of which they actually made up. So it's just a reminder that sometimes the results that you get from something like this are, I'm going to sugarcoat, suspect. And there are some good companies on here that deserve closer attention, but there's some on here that perhaps don't. And then last but not least, we do like to always check for companies that have just been beaten down. The stock price has been literally massacred, and we look for them by relative strength index less than 30. So you see that in this column here. Again, relative strength index, RSI. This is the 14-day look back version. If you are not familiar with that as a measure of stocks that are potentially undervalued or oversold, go to stockcharts.com, and in their chart school, just enter RSI, or relative strength index, and you'll learn why we pay some attention to this. Looking down the list, we're looking for quality. Ken always breaks out into a rash when he sees all these red numbers for quality. And but you see that United Health has a decent quality rating. That's after some of the stuff that they've been through recently, and decent return forecast. You see the value line version here. You see the par, and so United Health is attractive. Might stretch a little bit for Copart, but this number's a little bit low, and not a whole lot of candidates. So here's what the list comes down to. Just collecting up the ones which might survive a preliminary screen. And again, keep in mind that all of this is screening. This is the first step in the process, not the last. So you got a couple of good candidates up there at the top, and there's a few more along the way that are less qualified. We've been doing a lot with projected cash flow growth at Manifest lately, so I put that column in here just to demonstrate what some of those numbers look like. We like double-digit growth there also. That fuels the business going forward. You can see a number of these companies are relatively large, and you can see a fairly wide berth of projected annual return, and for that matter, quality. So people ask me, well, what do you do with a list like this, Mark? Well, I just start whittling and throwing companies out. Here's what that looks like. Literally going down the list, tossing out anything with a low single-digit projected annual return, throwing out anything with a quality under 80 or 60. And you can see I've basically redlined all of them just to get it down to a list that can be assertively pursued. So NICE, which is a holding in the portfolio, United Therapeutics, setting the stage for Cy Lynch here in a few minutes. Both ranked pretty good up at the top of that list. ASML, as mentioned earlier, some fairly decent characteristics, and down the list. Here is a look at some of the other characteristics we might think about, just again, looking for other opinions on these stocks. So in this case, we're basically looking for these two columns to reconcile with each other, as we do, the projected return on value versus the par. And then we're also looking for, well, what are some of the stronger ones on the list? And I circled those in green. The ones circled in red are kind of deal stoppers. Nike right now is projected to have lower sales for 2025 than they did for 2024. Chevron in a cyclical industry has the same situation. So I think of that as headwinds, and we don't need headwinds in the roundtable portfolio right now. So those two would basically be kicked off the list. This 1.46 means that of the analysts covering the company, 2 would be a complete strong buy, -2 complete strong sell. So Mercado Libre gets a pretty good vote. That should be considered a tailwind. A little bit of interest from the community. And again, you can see some fairly decent discounted prices on some of the companies according to Morningstar or the analyst consensus estimate. And United Health has they kind of run the table on the return forecast column. So that one remains fairly attractive to me. And you take it to the next step. And here we're going into the Hugh McManus playbook, because United Health definitely qualifies as a company to loathe. It's off the charts. And all of those synonyms down at the bottom apply to a lot of the stuff that you're seeing in the national press right now. And anytime I can learn a few new words along the way, that's a good thing. And there's just a whole lot of loathing going on with this company. And then you turn to the right and you see the most recent, and this is the current edition of Value Line, basically talking about it in the other way. They see a long-term buying opportunity. This is a company that is well positioned. It has tremendous challenges, changes in leadership, Just about anything you can think of that could possibly be going wrong, that's happening right now at this company, or at least it's being claimed to be happening at this company. It went from a safety rank of 1, virtually untouchable, to 3 in average in the most recent update. And they went from an A+ rating down to the B++ that you see here. And plus, they've got an acquisition that is causing heartburn. So there's a lot not to like here. We talked this afternoon that this is beginning to resemble the BP Gulf oil disaster, and wondered if we couldn't just substitute in United Health for some of the stuff that Hugh had to say about BP. It turned out to be a very successful selection. Again, this is running pretty cold, and it's got a lot of negative press. So let's take a quick look at some of the characteristics. First of all, we are talking about a company with a decent PAR, much like the one that Ken just showed. I also like to point out that it's at a multi-year high thanks to all of this bad news. Now, there could be fundamentals that weaken, but as for right now, things are looking pretty good. The quality drop probably has a lot to do with that downgrade in financial strength, but again, very, very decent long-term picture with a group of people who really know how to manage the insurance business. Some of them may need to be reminded, but we're looking at an interesting company. Here's a look at the sales for the company. I do not see any major disruption, at least not forecasted yet. A little bit of a downdraft here, but we're talking about a 9 or 10% growth rate as shown here. Fairly decent situation. The earnings are pretty steady, a little bit of a downdraft here while they catch their breath and deal with the current situation, and a PE ratio of 13.9, which is pretty attractive. How attractive? Here's a quick look at the picture. I think you can easily make a case for a PE ratio somewhere in this range, somewhere in that 15-ish range. And you can see that the profitability of the company, again, a little bit of a downdraft or a stumble when it comes to net margin, but the overall profitability as expressed by the operating margin, or you could think of it almost as a cash flow type characteristic, pretty strong, pretty steady. Here is a look at the cash flow over time. Again, a bit of a downshift, but nothing catastrophic. And we're looking at, again, double-digit cash flow growth, so they've got that going for them. Decent debt when it comes down to how much are they paying for an effective interest rate. Hugh McManus likes to buy companies like this when they are down in the bottom 20% versus their projected or their low price. These guys are within 12% of the low price, so it's down into that range. You see here a breakdown of the high and low value line forecast. So we're basically looking at a 19 or 20% return forecast based on the current price. Morningstar is calling it a 38% discount. The analysts are at 40. And here's that relative strength index under 30. You can see the price drop. The company is heavily loathed enough to basically knock 50% off the price. And yes, I'll say the words, if we liked it at 600, we really ought to like it under 300. So that just cursed it, by the way, and I probably just lost all the votes. But it definitely has been hammered, and it's a company that has a decent future if they can get their act together. They have brought back in a highly performing chief executive from a few years ago to basically conduct some of the remedies and repairs, and we'll see how he does. And I'll just close with the Value Line Supplementary Report. I kind of find this fascinating because we've been talking about this for a number of other different companies, but they're having a lot of problems because of the people who deferred healthcare during COVID and the slug of extra business. My dentist is, I think he just bought another boat thanks to this phenomenon of people coming back into the office after taking a couple of years off. Same is true for a lot of hospitalization healthcare and that type of stuff. Elective surgeries are up, and that is actually causing some real challenges for the insurance companies. You can see they talk about the CEO coming in, and then I'll just leave us with this thought. anything that can be chronicled or written up as bad for this company is definitely out there. And I've questioned whether or not it's not a kitchen sink. They're basically throwing any bad news they can out there to get it all out there at the same time. Can't get much worse. And this company does have a strong track record of dealing with this type of a challenge. So I think it's worth considering. And it's already in the roundtable tracking portfolio, but would like to add another $1,000 to it and average our price down a bit.
Mark, I have one question for you. In any of your research, did you come across anybody suggesting that the dividend was in trouble?
I didn't, but I wouldn't be surprised. I mean, it probably really isn't, but anytime you see this type of a downdraft in the earnings, if that persists, you could see pressure on the payout. This company is in that 2 to 3% range for dividend yield, so that could have some impact, but I'll do a little bit deeper dive on it and report back perhaps at bull session, because this is in the Buttonwood portfolio also.
Thanks, Mark. A very interesting situation with this company right now. We're going to move to Cy Lynch now, and Cy is going to repeat his selection from last month on United Therapeutics. Go ahead, Cy.
All right, thank you, Ken. And as you mentioned, this is a repeat of last month. I'm surprised Mark hasn't asked if they've made an acquisition to get into information technology. I hear that is a hot rumor, but it hasn't come to fruition yet. And actually, this is the third straight month United Therapeutics is mentioned after Mark and Ken kind of started the trend 2 months ago. And I won't focus as much on the company itself tonight, again, because you've had 2 months talking about it. Some of the slides from my last month's presentation I've updated, but we'll kind of look at why I thought it was worth me doing a repeat and actually a three-peat for the portfolio as a whole. Start with the value line potential of 20% in 18 months and a wide range. And that's really the characteristic of United Therapeutics, is it has a wide range, and you could see a fair bit of price volatility over its history, but a definite over recent years of steady uptrend in revenues and pretty consistent uptrend, at least for the last 4 years, in price and earnings as well, or earnings and pre-tax profit. Next slide. Here, this month, I decided I would do a repeat selection out of the portfolio. So I ranked the portfolio by par, and you can actually see Schlumberger and United Therapeutics are the first two companies out of the yellow. And you notice the solid quality, and then I've also circled growth rate over 12% and super high financial strength and earning stability. And again, in this time of uncertainty, I was looking for as much assurance of ability to face whatever the market may throw at United Therapeutics or at the company in general, a hypothetical company. So that caught my eye, and as Mark said, it's just a screen, and we'll keep looking. Next slide. Here's just a quick industry study in comparison, ranked by quality. 3 excellent quality companies in the portfolio, and this was the best by par, by potential return. You see it's not quite as high a potential growth as a Novo Nordisk, and it doesn't yet have a projected yield, or doesn't yet pay a dividend, and one isn't projected. But again, it's certainly competitive, and based on par, I would say is pretty much the best option in the biotech industry right now. Next slide. And then I did a screen against all of the manifest database using a 14% par, which that was just rounding down my par plus 5, really making it about my par plus 4 as it worked out, with quality of 90%, financial strength of 90, and earning stability of 90. Again, a little bit lower than the super high numbers for United Therapeutics of that, and you see only 3 companies met that criteria, and they would all be excellent candidates. United Therapeutics has the highest sales growth, as well as the lowest PE required to get a very solid par. So all of this tells me, just reinforces that United Therapeutics is a very solid, I don't want to call it conservative pick, but much safety built into it. Next slide.
Cy, I'm going to interrupt you. I apologize, but I'm anticipating a question about Fastenal. And folks, I'm reasonably certain that that Fastenal line represents an unsplit stock. It just recently split 2 days ago. And so that those numbers are wrong for Fastenal, Cy. So we should just eliminate that completely. The 4% growth giving the 19% par is because it wasn't split.
All right. Very good for catching it, because I have to admit, since this was more of a double check, I hadn't even noticed Fastenal there until just now, and my jaw kind of dropped at it too. So
I know that our audience would have had a lot of questions about
Hey,
good. Thank you for catching that.
I was already dialing up my broker.
Yeah. When I saw Fastenal there, my jaw kind of dropped, but now we know why it's there. Next slide.
Thank you, Ken.
All right. This is just the intro to the United Therapeutics presentations that they give, and it just mentions that really what they are looking to do is to treat rare diseases. And they've branched out in more recent years beyond just medications for rare disease, but to increase availability of transplantable organs by expanding the availability of organs through primarily genetically modified pigs, but other ways that they're looking to expand transplantable organs. Next slide. Here's the same summary that I gave last week. And again, it was founded by a family seeking to cure their daughter's pulmonary arterial hypertension, which is still their primary focus in rare diseases. But they have expanded beyond that as well. Next slide. Again, just a few more words about their rare disease focus and moving into addressing the shortage of transplantable organs, because again, for these diseases, they saw that as a logical next step, because oftentimes end stage PAH and their other diseases they focus on, organ transplant is the only alternative to eventual demise of the patient. And the other thing that I just want to highlight is that they have chosen, I believe it was about 5 years ago, to reorganize as a public benefit corporation, which is still a for-profit corporation. It's not a not-for-profit or non-profit. It's still for-profit, but along with taking care of shareholders, they are public benefit corporations are required to also consider public interest in making their corporate policy decisions. So it's kind of a hybrid sort of entity. Next slide. This is one of the updated slides because I did release first quarter results. No major difference in the first quarter over historical results, except it was a record revenue quarter, and both company-wide and, as you'll see on these slides, for many of their key medications. Next slide. And this is really the way the company is looking to grow. The bottom tier being the foundation, which is their commercial portfolio of approved medications. Then they have what they term their innovative, their new in the pipeline portfolio medications, and then their more revolutionary expansion that they're looking to increase potentially as high as $16 billion in revenues with the Xeno medication and the organ alternatives that I've alluded to several times already, which are about ready to go into full clinical trials within the next few months. Next slide. Just more detail on that previous slide, giving you some words if you want to dig in more. Next slide. All these slides were in last month's presentation, except for the ones I've updated. I've taken out a few slides also, and I think several of them go back to 2 months ago as well. This is the updated revenue growth by quarters and by medication over the last 5 years, and you see a 17% compound rate of growth, and the Tyvaso, which is their leading med, was up even more in the last quarter, a little bit lower, particularly in that Unituxin that was flat for the last quarter, but still solid 17% overall growth. Next slide. Again, just summarizing where the company as a whole, 18 consecutive quarters of year-over-year revenue growth, and hit a record for the year. And here are their market leaders, again, most of which hit the highest revenue ever in the first quarter of 2025. Next slide. And this is really why the bottom line, or why I was convinced to repeat it again this month, is that financial strength about as good as you can get, earning stability nearly as good as you can get, and an overall quality rank of 94. So again, an extremely high quality company, but with tremendous potential growth at the current price. Next slide. Here are my judgments. I chose to use 9%, which is about the Morningstar ACE projections for the next 5 years. It's a slightly above, slightly below value line, but right about in line with value line as well, and is a couple of about 3 percentage points below Manifest's consensus. The profit margin I increased a little bit this month based on the last quarter, a little above the 5-year average, but still somewhat below the current profit margin, and about in line with Manifest now. And that gave me $35.78 projected EPS 5 years from now. Next slide. And using those projections with PE of 17 on the high side and average PE of 13.5 leads, not blowout returns, but very solid potential return of 15.3 using the high PE or using the average or a par of 10.1. Both of those, though, should be compared to the manifest range. And in fact, actually, my potential low, if you will, of 10 is right in line with the value line low, but the value line has a much higher potential ceiling, if you will, on the return at 21%, and manifest par also is significantly higher based on a higher PE ratios as well as growth. And then we'll close out with the last slide, which I don't use in every presentation, but again, I think just reinforces where this extremely high quality company falls. If you look at the Chronicle, this is the history of the potential return and quality as well compared to the prices over the last not quite 5 years, a little over 4 years. And you see during that time, the highest potential return measured by par was in the 12% or so range. You see it's well above that. That's the green line bar that you see running across there. You see the red line crossed that bar in late summer of last year, I guess June or July it looks like, and has remained above it ever since and is poking up. And what's nice is that the quality has remained very steady. Can't really go up much more than it is. And much of that decline, though not all of the decline, is because the price has pulled back. I think, truthfully, the price just got ahead of itself. Right now, the current PE is down around 12. Remember, I was projecting a high of 19, so there's certainly significant PE appreciation potential, and so I'm adding another 1,000 of United Therapeutics.
Thank you, Si. All right, Ken, I think we're ready for a poll.
There's a question, Mark, for Si, if you would happen to know. How many companies are a public benefit company, and who recognizes that it's a public benefit company, or,
Okay, as far as the first question, I have no idea how many companies are organized as public benefit companies. Now that you've asked it, I'll take a look and see if I can find out. This is the only publicly traded biotech company that, at least according to management, and I have no knowledge to the contrary. So within the biotech industry, publicly traded, it's the only one. As far as who sets them, that would be companies are incorporated under state law. And so that would be a state law determined requirement that they would set out the, what makes a company a for-profit entity or a nonprofit entity or a public benefit company. And I believe that United Therapeutics, as many American publicly traded companies, is a Delaware corporation. So it's under Delaware law.
Thank you, Si. Mark, before I launch the poll, Daryl has had his hand in the air patiently waiting to ask a question. So Daryl, you're unmuted. Go ahead.
I did that by mistake.
By mistake. Okay, thank you. I'm going to take your hand down, and I am going to launch the poll then. And here's the poll. And we're asking you to pick one of the companies you think you might like to add an extra 1,000 to, and we will then do that in the tracking portfolio.
He's still my beating heart.
You're in double digits, man.
I'd like to get up to 80% voting if we could.
I'd like to get 80% of the votes for me.
No, you're not going to have that. Let me tell you. All right. And I'm going to kind of count to 10 backwards in my mind, and then I'm going to close the poll down. We did reach 80% voting. You still have time to put a vote in if you haven't done that yet. 5 more seconds.
Kind of like the Kentucky Derby. Kevin's company was strong out of the gate, though.
Okay, I'm going to close the poll and share the results. And we've gone back and picked United Therapeutics again, Si. So we picked it two months ago, and then we're picking it again this month. IES and United Health had a really strong second place. And I'm sorry, Kevin, you did go past your 12% that you've set as a goal, though. So you're at 15%. Okay.
Dramatically exceeded expectations.
I am shocked that I got 15%.
Okay.
Well, it must have been Ken's actual fashions conscience.
Yeah.
Yes.
Yeah.
I know what it really was, Kim, is that the fact that I threw in the fact that Ken liked Louis Vuitton, so therefore they said, oh, if Ken likes that, then maybe they'll like other fashion stuff too. So I think that's really what it was.
You guys are just terrible.
Style.
You're just terrible. Okay. We're back to the presentation, Mark. Go on.
All right, and just for fun, we did this last month. I just thought I would ask Super Grok which of the 4 did it like, and it actually doubled down on Ken's IES Holdings. And then just to show you how crazy this AI stuff is, I asked just Grok, not Super Grok. Same question. And in this case, size United Therapeutics won. So I mean, wow. Anyhow, that's just FYI. But we'll obviously come back and take a look at who's right at some point in the future. Super Grok, which is the premium service, which is at least temporarily costing me 20 or 30 bucks a month. I don't think that will last, but just trying it out. And interesting that those two are different. As Ken mentioned earlier in the presentation, we do archive all of these sessions on YouTube. So you can actually go back and catch old roundtables if you want to go back and see what we said when. And our bull sessions are also there. And just an opportunity to have some fun. All right. Ken, would you like to describe our participation coming up here in a few days? All 4 of us are our presenters for the conference.
Yeah, we're going to be presenting at the NAIC Virtual National Convention on June 7th. That's an upcoming Saturday, a week from this coming Saturday. And then again on June 14th, there's I think 18 classes, 9 classes each day, and it's going to open with a stock panel. And Si and Mark and myself are going to be on the stock panel. We're going to be joined by make sure I get the names right now. Robin Ware, Betsy Wills, and Pat Donnelly are going to join us on that stock panel. We hope to have a couple of good choices per person for you to consider at that opening stock panel. That will be at 10:10 in the morning Eastern Time on June 7th. And then the June Roundtable is at the normal last Tuesday date. The Georgia Investor Fair. Si is going to be at the Georgia Fair. Mark, are you going to be there this year?
Yes, sir.
Mark will be at the Georgia Investors Fair. That's always a really good program. Is this one virtual or live, Mark? Do you know?
It might be hybrid, but I know that it's live. I mean, we're going to be.
Okay, so you're going to actually be there physically, okay?
Mm-hmm.
So I'm sure if you go to the Atlanta chapter, they'll have stuff on their webpage. It might not all be there quite yet because this is in August, but we are going to also be presenting to the Alabama chapter at their annual meeting in June. I'll give you a date for that, in fact, on June 17th, the Alabama chapter is having a virtual session, and Mark and I will be presenting at that virtual session. Don't forget about the bull sessions at 2 p.m. Eastern Time every Tuesday afternoon, and the Heart of Illinois Breakfast Club Wednesday mornings, 9 a.m. Eastern Time. I know that's early for a lot of you, but they're getting up at 8 to do it. So that's an interesting program that if you haven't ever been before, you might want to take a moment and visit one of them just to see what's going on. I don't have any other things coming up, but as usual, if you'd like to hear from Mark and I at a club meeting perhaps, or at a chapter event, give us a ring. We'll see if we can fit you into our schedule. We love to meet folks in person. We had a wonderful presentation, a wonderful group of people in southeastern Michigan. First time in a long time we've met a group of local folks face to face, and we enjoyed ourselves thoroughly. So if you're looking to plan something in person or virtual, give us a ring and we'll consider helping you out. As always, a big thank you to Mark Robertson, who is a director for the Mid-Michigan chapter and just does all kinds of things to help us do quality programs. Cy Lynch, who has given so many hours to better investing and has been a regular on this program for about 15 years now. And then our special guest, Kevin Galogli. And Kevin, I want you to remember that every time I've asked you to be on the program, I've given you at least a week or longer, okay?
Noted.
Okay. So with that, I'm going to say good night to everybody. Kevin, thank you so much. It really was a very interesting shot you took, even though you took a couple of shots at me as well, but I can deal with that. So, but I'll get even at some point. All right.
Mark paid me to do that. How do you think I was able to make this big money off of it?
Great, terrific. So we're going to say good night to everybody. Thank you for being with us, and we hope we see you at the round table on the last Tuesday in June. Good night, everybody.
Good night.
Good night,
Thanks
everybody.
all.